Okay, let's get started amortizing loan practice. As we discussed in class, this practice is really important uh, in terms of the calculation of the amortizing the principal of the loan, like the payment of the car or the payment of the rent or payment of the mortgages. All the payment, the recurring payments every month are the same amount, but the payment is comprised of two parts. One is the interest and the other one is the principal. So we want to know how much we pay the interest as a whole in over the life of this loan, or how much is the principal amount in the same level of the payment every period. So let's get started. Consider 4-year amortizing loan. You borrow 2,000 initially and repay it in 4 equal annual year-end payments. Okay, this is year-end payments. But if it is the beginning payment, we have to use the type 1. But let's make it simple. The annual payment, the interest rate is 8%. And then a number of period is 4 years. The payment is what we want to know. What is the same level of the annual payment for 4 years? And then the present value. So we always take into consider the direction of cash inflow outflow. So if you are the borrower, so $2,000 is cash in. Then the future value of this $2,000 in 4 years is gonna be 0 because you paid all the money out for 4 years. Then how do you calculate it? It's very simple again. We use PMT function, the rate, MPR, and present value, and future value. It's type 0, but you don't have to put because it's automatically recognized type 0, the payment ending year. So the annual payment is 603.84. Okay, so you're gonna pay this amount 603 times 4. So total amount is not $2,000 you pay back. You pay 2,415. So 415.37 is total interest amount. But we'll figure it out based on this amortization schedule. Okay, so let's fill out the loan amortization schedule. Okay, year 0 at the starting point, the total year and the payment is 0, and year and the interest due on a loan balance is also 0. The amortization loan, because it's not started yet, the loan balance when the start was just $2,000. So I just want to use the equal sign so that you can see this is just 0. Okay, then year-end payment is 600. I want to just put here, it should be, accounting. Okay, good. So 603 point, I want to see this, the full value as indicated in the payment. So the payment is $603 every year. And then the next year also the same, the next year. So for 4 years, every year, the sum of this is 2,415 as we calculated earlier. Now the year-end interest. How much is the year-end interest due on a loan balance? So 20,000. There we go. 20,000 now times 8%. I want to just fix this so that Oh, wait. I'm sorry. Should be 2000. So 160 is the year-end interest. Year-end interest, then actual amortization of a loan is 603, the year-end payment minus interest. So this 603 is comprised of this 160 interest, because the 2000 was the loan balance at the beginning, and the the borrowers has been using this money for 1 year. So the interest of this 2000 is 8%, so 160 is the interest expense part. And then the amortization of a loan out of this 603 is 443. Then next, then how much is the loan balance? We want to see the loan balance. So we can calculate 2000 minus this. So the loan balance remaining is 1556. Okay, we should subtract only the loan amortized date, loan amount amortized. Okay, then let me just drag to the right, so you can see that it is automatically calculated. Then amortization of a loan also is calculated automatically. The loan balance based on this calculation. Now, as you can see that the second year end also is calculated, the remaining loan balance of the prior year ending balance times the rate 8%, so that we can calculate. So this interest subtract this 303, so that amortized loan is the part of this 603 out of this 100 other, except for this 124 interest. So the remaining ending balance is calculated. So previous ending balance minus actual principal of this loan reduced. Okay, in the same way. The last year after payment, the interest based on the last balance times 8%, and then amortization loan is calculated like this, so that this borrower doesn't have any loan balance because paid out the full amount, 603, the last year. So let me just calculate one more time the sum of the interest, 415 to see out of 2,415, 415 is interest. And then loan, amortizing loan, which is the principal. I just want to make sure that this is the principal, right? Principal. Total principal is just the sum of this principal, should be the same as $2,000, the beginning balance of the loan. Okay, so you can use this process in any cases related to the payment using this the loan concept. The same the payment, like mortgages or the financing leases or the operating leases of your car or the rental services. So it is comprised of these two parts of the interest and the principal, so that you can identify what is the actual loan balance remaining every year or every month once you paid. We can apply this is definitely mortgage practice later. Okay, see you in the next video clip. Bye bye.